All right, we'll get started with our next panel as a few more people come back from lunch. So our next session is all about loyalty in FinTech, and we're talking about gifts and more. I'm keen to hear what the more is and very excited to understand what this QR code business is all about. And on our next panel, we have Claire Kinsey from Carter, we have Deborah Taylor from OpenSparks, Rochelle Eldridge from CBA, and moderating the panel is Chris Titley from Sub11.
Thank you. Hope you all enjoyed your lunch, and hopefully you don't drift off this afternoon after a nice big lunch and a second day. So we'll try and make this entertaining and have a bit of fun, and hopefully you can learn a fair bit about what's happening in loyalty and FinTech. So first question goes to Claire, which is to my left. Hi, Claire.
You're all business.
I am all business, right. Let's do it. Let's do it. Right. Gift cards. So do people still gift gift cards? Because I know in my life, like I don't really like receiving one, but if it's someone that sort of I don't really know, it's okay. Is this what happens still?
Yeah, gift cards is actually a $47 billion market industry here in Australia, and it's forecasted to be about $1 trillion globally by 2026. It's not insignificant. I think it's fair to say gift cards are pretty old school though. So, here we go, a bit of fun trivia. 50% of all gift cards sold still are physical. And what card is here for is to sort of bring it into the 21st century and make it a digital first solution that's tokenized, secure, and enabled through your mobile wallet. And that's what we're here for. Fun stats though. Corporates love gift cards for their use. So about 50% of the market's on a corporate perspective, and then 50% is for consumers that go into the shops and buy them. Better? Good. Sorry. So yeah, and then within that, gifting is still really, really important. You'd think a gift card is used for gifting, but no, there's a lot of self-use as well. So again, depending on the environment, right now, given the macroeconomic environment, people are using it more for self-use. They're using it as a budgeting tool, and especially if they see an offer or a discount, they can actually take advantage and use it as a cash flow management tool as well.
And then when you get a gift card, there might be like a potential expiry date on it, and do people use them? Is there a whole lot of like unused gift cards sifting out there in the ether somewhere?
Absolutely. So again, depends on the segment. So if you've got an entertainment or an experience gift card, like a red balloon card, there's up to 20% expiry of those funds that are available, which is really crappy experience, right, for the customer. People tend to forget to use it, or they're not aware of the balance on their card. But yeah, again, Card is in the business of trying to break that model, actually put the customer first and get them to actually engage and use it, and therefore grow the market, rather than a lot of incumbents today tend to rely on that expired float or balance that's available, because it's a revenue line for many businesses that operate in the industry today. So we're all about trying to change that game.
Rochelle, I'm going to go over to you. Working at CBA, can you describe your role at CBA and what you do in regards to loyalty within FinTech?
Yeah, thanks, Chris. I am the GM of shopping at CBA, which is an enviable title for many working at the bank. What that means, though, is I run an area which is sourcing discounts and like discounts, cashback for our customers, so they save money on things they need to buy. So it's a really, really exciting area. And I was lucky enough recently jump on a plane. I don't know, hopefully a few of you have jumped on a plane and come down here. I think I was lucky enough to jump on a plane. I did do carry on to get around the country, so I didn't lose my luggage along the way, but we got to do a trip around the world to speak to a whole lot of different loyalty, banks and fintechs, which was really interesting. So I thought I'll just share a couple of the things that I saw along the way. But cut me off if I keep talking, because I can get really excited about
my
this
watch
stuff.
is ticking. It's all good.
Firstly, really interesting. The holy grail is the purple cow. So I don't know if you know, purple cow is the old marketing expression for something that would grab your attention for at least 20 minutes. You can imagine a purple cow be quite interesting to look at, and you can look at it 20 minutes. So differentiation in loyalty programs is really what everyone's going for. The second thing is the freemium model, and we're seeing this in Australia, right? With Woolworths, the Extras program that they brought out, Uber One that they've brought out, and a couple of others where you pay and then you get benefits from it, but yet it's still a loyalty program. I think the third thing, which was really exciting, was the personalization piece. So obviously we all know loyalty programs is a big play, is the data side. And, what can you do from a personalization side? We saw examples like Lloyds Bank in the UK giving customers the option of choose one from four. So, your standard is that, hey, we'll give you mobile phone insurance and we'll give you travel insurance and we'll give you this, and you get what you get, right? What you can log on then and do is say, oh, I'll have a free Netflix subscription, or I'll have a free Prime subscription. And I think that's really good, because what we're getting to is a personalization. Like, what do I really want to make me more loyal to the company?
And just on that topic, in regards to programs that people join, I mean, like I'm a Uber One member or something. It's $9.99 a month or something, but I have to pay to be a member. Is that a thing now, that like you pay and then you get a discount, or if you don't pay, you don't get the discount?
Yeah, I think that's what we've seen recently. And I think it's a really interesting trend where you're getting better benefits, but you're paying for those benefits. And we've seen Woolworths move into it from Woolworths Rewards. They do the freemium model. So you've got your Woolworths Rewards program, but then you can step up and pay $7 a month and get 10% off your largest grocery shop for the month. You know, Uber One's the same sort of one. They started with a free program and they've moved into this paid model.
And Deborah, when a company does all these funky little loyalty programs, you're in the background working with them in terms of setting it up and establishing it. You want to talk about your business and how you fit in?
Yeah, sure. So OpenSparks is a platform as a service. We integrate directly with the schemes, Visa, MasterCard, EFTPOS in Australia, GCash is a QR payment code in the Philippines. So we register the merchant's ID with the schemes, and then the consumer registers their 16-digit PAN or their payment card, again, via us to the schemes. And when they transact at that merchant, we get that transaction data, we run the rules on that data, and we give the rewards, the points, the offer back to the consumer that the merchant funds. So this is merchant-funded rewards using your payment card as a method of IDing the transaction. So it's no more, get your flybys out or your whatever your loyalty coupon is, and then make the payment. It's a one swipe, one transaction. So it takes a lot of friction out of loyalty. I just want to address something that Claire was talking about in terms of breakage. So gift card breakage, big industry, but you're losing because the gift card owner, they get that breakage. If you don't bother spending your last $5 or your last 2 cents even, they are getting that, and that adds up. So with what we do, there's no opportunity for breakage because I'll just give you an example. So we launched the largest Asian loyalty program in a shopping mall in the Philippines just when COVID hit. And so that was with 30 shopping malls, 10,000 merchants, 2 million footfall a day back then. And so they couldn't actually do a loyalty program in any other way apart from issuing their own card or by going up to the highest level, which is the payment network, the payment gateway. So they're using our technology. And so a consumer can shop at all of the merchants within the malls. The points they get all are collected into their wallet, and they can then redeem that where they want to, either with the merchants in the mall or on Wi-Fi or assets that the mall owner own. And so there's no breakage because you're collecting all your points from all the shops within that shopping centre. And, so no breakage by having individual programs.
Deborah, you mentioned obviously rewards and the types of rewards people want and going into sort of the loyalty and fintech gifts and more part, like we've seen things like Upstreet where you get fractional shares rewards, you get cash back, you get 10% off. What's happening now? What are the trends? What are people doing?
Well, look, there's a lot of different things happening right now, but certainly people want to be able to pool all of their rewards and offers. They don't want to go to, one merchant one day and spend their money and get a little tiny reward and then go to another merchant and get a little tiny reward. And how can you actually redeem all of those rewards quickly? So pooling is the best way to actually get your value because you're being able to pool all your shopping at a lot of different merchants, not just one. So it's about pooling, I think.
And this is where CBA might come in regards to sort of integration with your digital wallet potentially and onboarding or at least kind of applying the discount, whatever it may be, without pulling out your Rebel Sport card from your wallet.
Yeah, I think I don't know how many you have of loyalty programs. I've at least signed up to at least 8 to 10 and probably a whole lot more because you get caught at the cash register and they say, hey, we'll give you 20% off if you sign up to our loyalty program. You're like, oh, yeah, that sounds great. People have a lot of loyalty programs that they're signed up to. I think, and to Deborah's point, they're not that useful. You forget about them. So, one of the great things I saw in the UK was this notion of card linked loyalty, where you have all those loyalty programs all linked onto your payment card. So you spend at your payment card and then you get the points or the whatever it is, the stamps or something like that, all applied to you as your account. You can see them all in one place. That was pretty cool. I got very excited personally.
And Claire, when it comes to the digital gift card, like your application use, are you working on a B2B model or a B2C model, and how does it work? I know you gave me a gift card voucher, and I think there might be one on the screen. I don't know. I don't want to ruin things, but don't get out your phones just yet. But in regards to like the usage and what people are spending when it comes to gift cards, and obviously with 150 interest rate rises in a row, we're going to see people focusing on their wallet a bit more and trying to use potential discounts and gift cards. Can you talk about that?
Yeah. So, yeah, we're in the business of both B2B and B2C. So, special.com.au, you can see up there, Intersekt just became special. That's a good play on words, everyone. If you scan that QR code, we're going to offer you guys, if you just fill in the form, we'll give you guys a coffee cart.
Oprah Winfrey, here we go.
Oprah Winfrey, it's prize time. So
well done to the lucky 40 that joined us.
I think everyone likes coffee, and if not, you can have a chai latte or a peppermint tea, I'm sure. But, go ahead and use it. Just
scan away, people.
Yeah, get the experience, because I think what we want to do is show that consumer offering. But from a B2B perspective, I mean, we've got great partners in the likes of MasterCard, obviously CommBank, etc. But we're in that business as well of working with retailers, working with many HR companies as well. And coming back to your second question about sort of what's the usage, obviously retail, big retailers, the likes of JB, Hi-Fi, Myer, David Jones, all the standard ones are very, very common when it comes to gift cards. But here's a fun fact. There's about 164,000 retailers in Australia, and yet only 3% are actually in the business of gift cards. And a lot of that comes back down to the effort, cost, and time it takes to actually set up and run your own gift card program. So Carter is actually all about focusing, growing that size of the pie fivefold. So of that 47 billion, obviously we don't want to claim a share of that. What we want to do is open that up so that any small, medium or large retailer in Australia can actually be in that business. And it's a very slick onboarding process that takes days. You just send your business details, your brand assets, we'll load you up and we'll get you set up pretty quickly. So that's what really we're about. We want to be that one-stop shop, that one platform for gift cards in any way, shape or form.
Do people know what the discounts are on various retailers, and how do they find that out? I mean, like for instance, I'm with Suncorp based in Queensland, and they have a rewards thing, and you go there and you're like, oh, a Woolworths voucher, that's interesting, because I shop at Woolworths every week with my 3 kids, and you're like, oh, 4%, that's interesting. And so then you go through the whole process of putting your name in, and you get 4% or 3% off a week, which could be $10 or $5, whatever it might be. Like, is that a thing? Like, do people look for that type of percentage all the time, or do people know about it? I don't know, just like brand awareness.
Look, I think there's always going to be bargain hunters that are out there looking to save some money. There's also going to be, coming back to gift cards, that incidents of gifting usage as well. What we're not about trying to offer a discount per se or a value add in that point. That's that piece of loyalty. We're really about enabling businesses and consumers to use gift cards as they would in any way, shape or form. So can I go rogue here?
You can go rogue. Let's go rogue.
So just as an example, like I said, 50% of all physical gift cards are out there today. Part of our technology is the ability for you to scan.
The 2 mics, yeah.
Thank you. You're holding my microphone. I'm giving coffee cards, people.
Yes.
You can hold.
You get a car.
You get a card. So you can literally use your phone, scan it against your camera, and convert that into a tokenized digital wallet. So that's something that, thank you, we've enabled as well, that technology. And that's really what we're all about, bringing new experiences to it so that people want to use these cards more. They want to buy more gift cards. And we come back to growing the size of the pie rather than taking a share of the existing pie.
Deborah, the onboarding process in terms of loyalty and gift cards, I walk into JB Hi-Fi and said, do you want to join? You're like, in your head, you're like, here comes 2 pieces of paper that I have to fill out and they want all my data. And like, is that getting better? Or am I just not shopping at JB Hi-Fi too often? But, like what's the process? Do people like have this inherent like, oh, well, yeah, I'll join, but it's just a data grab, or what's going on?
Okay, so our best use case, we're a B2B, and so our best B to work with is a company with a large member base. having a large member base, they want to actually bring in merchant offers to that member base to give those members value. And so in our platform, it's very simple. A program launches. They sign up the merchants into the program. So for the merchants, a one-time onboarding process. We get the merchant ID that goes to the schemes. And then on the other side, the consumers register their details one time. And we don't want a lot of PI. We don't need to know any of that. It's all up to what the program owner wants to give. But it's very, very simple, one time, and then all you do is shop at that merchant or those groups of merchants, and you get the cash back or the points or the value that the merchant funds. So it's really simple, very frictionless.
Claire went a bit rogue here, so I'm going to go a little bit rogue with Rochelle on the stage here about loyalty working in a Big Four bank. You know, like I grew up with the Dolomites, and a lot of people are loyal with Commonwealth Bank, and that's why. And I've done a few polls on LinkedIn, and yes, people still bank with Commonwealth Bank because of the Dolomites. How much focus is on, you know, keeping that customer and loyalty within the bank, as opposed to maybe other customers that use Upbank, for instance?
Yeah, I think it's key, right? There's so many of you guys in the room probably that were Dolomite accounts, and we get it every day. I was a Dolomite account holder. And it's so key for the bank to be, recognizing the customers for their loyalty, but also rewarding them when they do more banking with us. So, I think that's the key thing. We announced fairly recently that we're piloting a bank-wide recognition program for rewarding and recognizing customers for their loyalty. And the area that I run, where we're looking at helping our customers save more, is part of that.
And part of your role is looking at other different partnerships in and outside, what a traditional bank might do. Can you talk about a couple that you've done?
Yeah, I mean, pretty obviously from a bank's perspective, we don't do a lot of retailing. So we're looking to our partners to be able to do that. So we work really closely with MasterCard. We also we did a partnership with a company called Little Birdie, which is an amazing brand new shopping aggregator platform looking at saving customers money. It was really interesting. I was talking to my boss last night, and she said she was interviewing someone yesterday that said they were researching to have this interview with her, which is smart. They came across the Little Birdie partnership that she'd done, and they logged on and they saved themselves $300 just on what they were going to buy. So, that's what we're all about. Whatever I can do to help our customers save money on things they need to buy is really exciting. And then the gift card partnership is super exciting. To what Claire's said, just getting gift cards out there, but also if people want to use gift cards for themselves, that's great. And then hopefully what we can do with merchants in the future is take sort of, if you've got, I don't know if they're in Melbourne or where you live, but, Messina ice cream is always the one that I use. Wouldn't it be great to be able to send an offer to people who live within a 5K radius of Messina, a $5 gift voucher to go get a free ice cream? That's the power of what we can do with gift cards.
Interesting. From a loyalty program per se, and again, drifting somewhat outside of FinTech, like Qantas Frequent Flyers, for instance, like why have they done so well, do you think? And everyone knows their brand, and most people pay the money to sign up, and in its own right within the Qantas group is a very meaningful part of their business. Like, can others mimic that, and why are there not more Qantas Frequent Flyers that people are so loyal to?
Yeah, I think that's a question for me, but anyone in the room can add to this. I think they have a highly complex program that they're managing to deliver really, really simply. So you'll get it. And they're also then innovating on top of it. It was at one stage, I don't know if it's now, but it was valued higher than the airline when you did a valuation on it. The engagement that it gets and the aspirational feeling you get when you engage with the program, I think is really exciting. And the only other thing I think it does really well is it enables you to get access to things that are lower value for them but higher value for you. So they can give away, seats, or they can give away those sort of things at a much lower marginal cost than what we can actually buy them for.
And Claire, that feeling that you mentioned there, Rochelle, about like you've just scanned to get a gift card. I mean, in theory, you could just stand at the door and give people $3, right? Like it's kind of that. But when you get a gift card and you go to a coffee shop, you're like, oh, wow, this is cool. I got a gift card. I went to this session. Did you go to that session? No. I did. I got free coffee. How good's that? Even though the coffee's free, but outside of this, with the walls, right?
Correct.
But it's a feeling thing. So how do you kind of keep that feeling alive?
Well, that's why we went for the name Special. It's all about invoking that emotion and that feeling of show me that you know me. So if we go back to that whole gifting ethos, it's about offering a solution to someone that you care about, where you want to give a gift that matters, but you may not know specifically at that point in time the actual item that you think would resonate. So this broadens that for you. It gives you that choice, but it still allows you to land it and present a very thoughtful, really great, nice, wrapped up, pretty. If anyone's downloaded it, you'll see that you get the woohoo when it comes and stuff like that.
You like the pokey sound.
Yeah. So
just to induce the happiness and things, eh?
Yeah. So it's just all about making that experience mean something in a new, fresh way. We are targeting. You'll see from our branding, we're much more targeted to the younger audience. It's all about coming up in that digital nomad first target audience, but it's really about using it in ways that matter. Having said that, it's a great compliment, I would say, coming back to loyalty for cashback as well, which is quite rational. That's usually a self-use type generated, how do I save some money? So this is a really lovely compliment to that.
One final question before we go to Q&A. Deborah, in regards to businesses and their mindset around a loyalty program or a gift card program, whatever it might be, as a business, is it high on the priority, or businesses are sort of too busy just doing their own thing?
Look, companies need to find better ways to market and sell their product and services. So with what we provide, it's very targeted. So people only take the offer if they want it. And so the business only pays for that service that we provide when the consumer makes a purchase. So it's actually a very streamlined, cost-effective way of doing it, because the merchant's only paying for what the value is that the consumer purchases from them. So it's an ideal opportunity for businesses to actually just target their marketing.
We've got about 5 minutes for Q&A, which probably be one or two questions out there. I'm sure there is some questions in regards to what's happening in FinTech and loyalty per se and gift cards. There's plenty of topics, but there might be a mic floating around. If not, stick up your hand. It's kind of, there is a mic. We've got a question straight up. You beauty.
G'day. Thanks, Nick from Canberra. Bit of a selfish one, actually, because all our clients are businesses. So it might not be the right panel to answer this, but just interested in any trends, observations around how motivated business owners are with loyalty programs and what types get them excited.
And when you talk businesses, are you talking large business, like any types?
SMEs to sort of lower corporate, typically maybe a family business, for example. So, someone with an Amex card, Amex points, Qantas points, that type of thing.
So in the SME world, it's very hard to do a loyalty program because you can't afford it. So that's why we've been so successful in the shopping mall space. We've got one in the Philippines. We're launching something in Australia soon. Just watch this space. And so within a shopping mall, you've got some big retailers, but you've also got some smaller retailers that actually cannot afford to actually do a loyalty program. So an amalgam of a group of small SMEs is a perfect opportunity for us to actually enable all of them to get some value, to give a reward or an offer to a member base. So we're also doing, I'm from Sydney, we're also doing in Sydney a localised loyalty program in the Surrey Hills precinct. And so again, a perfect use case for us. So the local residents can join a local program. The local shops, restaurants, bars, etc., they can put an offer into the group, and of course incentivise the members to come and shop, dine at their establishment. So that's the sort of thing that we want to really focus on.
Hey, Nick, I'm just going to add to that. It's a great question and so key, right? Because we've got so many small businesses out there. One of the things that we're able to do, and a lot of guys do this, is at least get it known out to customers. At the bank, obviously, we've got a lot of data on who's who. We know where they live or where they transact, and a lot of the offers we do are personalised in the way that we do offers out to there might be a cafe in Fitzroy that we can send out to, the people who live within 2 kilometres of that cafe. And I think, Claire and Dave's business in the gift card side is a really great way to do it, because you can send a gift card for a local cafe, a local restaurant that's just opened up, say, hey, come and visit us and have a $10 gift voucher on us.
Yeah, it's something we're really passionate about, because a lot of times you've got to integrate from a POS point of view. You've got to have a lot of set. We all know from small businesses how time poor they are, and they're focused on their own business. We've taken all that away. So we're setting it all up for them on their behalf. There's nothing they need to do apart from give us their business details and their brand assets, and we're off to the races. So that's why we really think that we've got a good chance of offering some value to them in a way that meets their needs first and foremost, but also can show incrementality to their business as well.
We've got time for one more. If not, I've got one floating in my head, but okay. We're going to cull it, but I'm going to go one more, which is your point about rewarding like longer use cases of people, like the revert, like your interest rate goes down the more you pay, and sort of struck by a chord, like let's say Xero. People use Xero maybe if you're a customer for 2 years and they work out the lifetime value of you and you're very sticky to them. Like, should more businesses be thinking about, okay, this person's used them for 2 years or 3 years, and then you get 10% off, and then you get 5 years, you get 40% off, and at 10 years, you get 80% off, or something like that. Like, shouldn't there be more of that, do you think?
Yeah, I'll kick off and then you guys add. And we see it in a number of industries, particularly insurance is the classic one, right? Where, you're an NRMA, you've been a member for this long, therefore you get this tiering of membership, and with that comes benefits. So I think it's something that companies really need to think about it, and it's just a juggle. You might have been a member for a long time, but, you might not be contributing to that company. So there's sort of a recognition and a reward piece to it.
Speaking of insurance companies, we have had conversations with a number of groups regarding insurance, because it's a grudge spend. And so insurance companies, and also they've got a high turnover, so high attrition rate. So insurance companies looking at how they can actually have their members benefit from merchant offers that come into the member that can then contribute to paying off the insurance. So that's a good use case that we're exploring.
All right, we have nailed it. We've got 29 seconds left. That's great. Good timing. I'd like to thank our guests today for, hope you all learnt a lot, and thank you.
Thank you.
All right. So, our next panel is all about the technology behind digital transformation in business banking. Speaking on our panel today, we have Shilpa Bale from Oracle, Simon Costello from Frankie One, Alan Beattie from Trade Ledger, Sarah Bolt from Prosper, and Rohini Goyal from Temenos. Welcome.
So, welcome everyone. Before I start with the introduction, I would really like to ask a question in introduction, right? Can you please introduce yourself and in one line tell about what do you think the business expectations have evolved in the new digital savvy world?
Hi there. My name's Simon. I'm the CEO, one of the co-founders of Frankie One. What we do is an aggregator for identity and fraud. So if you're familiar with KYC, AML, having to onboard at an SME, we try to assist and try to make it faster to onboard. So what I would say to, as far as digital transformation and assisting, is try to make it easier to onboard. If everyone's had an SME loan before or gone through the process, it is not typically a fun experience. That's what we try to help with.
Hi, Alan Beattie. Too many years a banker overseas. I'm working with Trade Ledger now. And what Trade Ledger does is try to make that process of accessing capital and lending for SMEs, making that simpler and supporting the lenders in their process of acquiring and retaining new customers. In terms of your question, well, we'll talk about it in the next half an hour, but I think, in a nutshell, we need to bring to business banking and the SME world what has happened in the retail space, in a nutshell.
Hi, I'm Shilpa. I'm a financial services industry architect with Oracle. I work with these strategic clients in APAC, which covers the big four banks here in Australia. And I try to help them create value with their investments when they partner with Oracle, and that can be across data, applications, industry solutions, and platforms. Most of my 20 years have been in the finance transformation space, that is back office, a bit of risk, reg, treasury. But in most recent years, I've started helping banks with the front office and digital transformations with legacy modernization and innovation. In terms of what I've seen in terms of business banking expectations evolve, to Alan's point, they're expecting the same experience as a retail customer. And we'll discuss that further. But in a nutshell, I'm also seeing that they expect the banks to go beyond traditional banking and start providing some adjacent capabilities to help with their business. So more on that to come.
Yep. My name's Sarah Bolt. I'm a product manager with Prosper. Prosper is Australia's #1 online lender for small businesses, and has a mission to achieve some of the similar stuff we've already been talking about transforming the way small businesses experience finance. And yeah, I'm there to help them build the products to take those to customers. And my background has been in technology, in particular data technology. And yeah, I agree wholeheartedly. It's about bringing those consumer experiences into the business banking, and particularly for small businesses, their expectations are very much aligned because they often are, individuals who are managing their personal finances with a different tool set.
So I'm Rohini. I work for Temenos, and at Temenos we do digital and core banking on cloud as a composable banking. And what we've seen is expectations not just from the retail consumer side, but also from the bank side to understand the small businesses has evolved. They want to understand data better so they can lend better, they can service them better, and they don't want to use people to do that anymore. No more RMs. So we're seeing a lot more automation, and they want to give that capability back to businesses to manage themselves. So more automation, more self-service, but for small businesses. So I see we have a lot more access to funds here. So Frankie Ones from Prosper and Trade Ledger, they all talk about access to fund. So I want to know is why do you feel the market has been so slow in getting SME sector access to funds? Right? Why have been we making it very hard for our small businesses to access their funds and get credits?
Well, I'll give it a go because as a banker, I suffered this on the other side. the problem we're trying to solve, I would bucket in the three C's. It's the cost of on a per customer basis, the cost of acquisition, the cost of retention, the cost of monitoring a small business customer is excessively high, and that has been exacerbated in recent years with the second C, which is the compliance burden. As I always like to say, nobody launders money in their own name. Everybody sets up a small business, and that's the way that some nefarious activity goes on in society. So society regulators are looking to the financial institutions and the NBF, the non-banks, and looking for support from the likes of Frankie One to really understand who it is that they're banking, because you're not just an individual, you've got ultimate beneficial owners, you've got directors, what are the contracts that are written between buyers and suppliers of the customer that you're looking to bank. And the third one is coverage. How do I reach out to the tens or hundreds of thousands of SMEs in the community today without having to rely on boots on the ground and relationship managers? So that's the problem statement I think we're trying to, in my opinion, that we're trying to get across.
So do you want to add on to that?
Yeah, I guess I add to that. So, yeah, I was going to say that there are two sort of interrelated challenges. And one, is there's just been, relatively speaking, less choice driven by those factors. And, compounding that, like we're still seeing for customers, lengthy applications with long wait times for decisions. And that makes it really burdensome for small business owners, for example, to shop around. If you have to provide reams of data and then wait many weeks, that makes it harder. So less competition in that space. This is something that Prosper sort of pioneered many years ago, is a bit of a step change in this area by leveraging tech that was there at the time around screen scraping, etc., to try and cut down those times and give that back access to data. We've heard a lot over these last 2 days that the likely next big leap in that space will come from the CDR. But we also heard in this room earlier today that small businesses in particular, there are some gaps in that framework at the moment for accessing that, which makes driving that change a bit slower than in the retail space.
Simon, would you like to add how you're seeing in the market?
I'd agree with everything that's been said. Ultimately, I say it's complexity, right? It's harder. It's so much easier for an individual, which obviously commonly gets compared to. And if it's more complex, takes more time, more money, etc.
So Shilpa, you work from Oracle, right? So you work with large banks. How do you see the experience for banks reacting to small vendors like Crossbar, Wiser, Judo Bank coming into market?
Yeah, thanks, Rohini. So the one thing that we saw during the pandemic was that the SMEs had to move businesses into digital heavily and very quickly. And we also saw how critical that SME segment was to the economy. And these expectations around, wanting the same experience as retail customers, wanting access to cash flow, having certainty to that decision making and faster decisioning, were all challenges that big banks, have been facing to provide seamlessly. And these became the opportunities that fintechs and companies like Prosper and Wiser have absolutely capitalized on, and tried to provide that gap. So the way I see banks reacting to that phenomena is in three ways. One, which is the most prominent reaction, is that they want to be partnering with these fintechs. Two, they're either acquiring or directly investing, in these fintechs that we heard from all of the big four CVCs, last evening. Three is a less prominent phenomenon now in terms of competing and trying to build and a competing capability out by themselves. And in terms of that partnering, I'm seeing banking as a service, banking as a platform, both models evolve, pretty nicely. And those partnerships are like, you look at Westpac Society One, ANZ Frollo, CBA Unloan that we saw yesterday, etc., all around us. And not just, Prosper and Wiser, but all of the fintechs that we've seen and heard from in the last 2 days, are getting similar reactions from the banks. So the opportunity is absolutely ripe for fintechs. I would add that having had some conversations with the executives at banks in this space, what I hear them say is that they love the agility and creativity that the fintechs bring, but they still, in some way, shape, or form, rely on organizations like Oracle for the robustness of security and delivery. And so I'm seeing another trend that I expect more partnerships for fintechs and big techs to start taking place for that faster scale and velocity, for superior unit economics that Alan spoke about, and for performance and resilience dependency. I know for sure that Oracle's being leveraging its decades of financial services experience, trying to launch a new cloud that's more fit for this kind of collaboration, fintech and innovation. So I think it's ripe with opportunity.
No, that's a great point. So taking a little bit of change, so we saw Judo Bank as a unicorn bank in the region, right? So the billion-dollar bank in last few years. How does Prosper feel about that, and how do you next steps to compete against those kind of vendors coming into market?
Yeah, so we probably operate at a bit of a different level in the risk space, so serving different customers from a bank like Judo. And if you want to hear more about how sort of fintechs are trying to differentiate themselves from the banks, then I recommend the next session in the next room where one of Prosper's co-founders will be talking about that very topic. But I guess from a sort of tech point of view, I think we're really on the precipice of seeing a lot of that creativity unlocked. So for companies like Judo, for Prosper, because the services that have come to the fore over the last few years, the tech services, some of which I'm sharing the stage with now, and many of which are represented at Intersekt, enable companies like Prosper to focus on serving the needs of their customers without having to build out the fundamentals themselves in-house, which is a real challenge in the sort of tech resource constrained world that we live in. So being able to leverage, banking as a service platforms, data as a service platforms, specific capabilities around AML, KYC, that enables companies to focus on what are their core differentiators, how they serve their particular customers, without having to spend so much time, establishing those fundamentals.
So that's a really good point. You mentioned data as a service and the data. So today's trend, we have seen a lot more about CDR, open banking, open data. So open data is to bring more competition. So my question on business side, it's currently available for retail and it has a very slow uptake. How do we see the transformation enabling the next stage of business banking through this data and the open platforms? So do you want to start, Simon, on that?
Happy to. Slightly controversial opinion maybe, though open banking and the like has been touted as a potentially a big shift. I haven't necessarily seen that in retail. I probably wouldn't necessarily expect a major shift for business banking. I think if you look at SME lending in general, it's quite a straightforward model. If you can get more data to make a better decision, you should have a competitive advantage. And then there'll be different distribution, accesses, coverage, cost, etc. Now, is open banking going to give you more data sources? I don't necessarily think so, because you can actually get that today through scraping and other means. So if you're not getting further data, more data sources to enrich your decision, I don't necessarily think it's going to help on the lending side. So that's just my view. Might be slightly controversial, only because this open banking has been very much touted as what the whole industry should get behind. Now it's going to change the world. I don't know. Maybe I'm alone, right? So I actually think there's going to be very different things. It's going to be the enabling technologies, right? That's actually going to help the 3 points that Alan mentioned. How do I reduce my cost? How do I reduce my compliance? And how do I reduce my coverage? If you can focus, that's the problem. And then if you focus on those three pieces, I think that will have an effect much more on the SME lending.
So I'll be a bit more positive here. Wanted to be slightly sort of, no punches there. Look, I think we spoke about the challenges, and we've seen retail banking, consumer banking progress in terms of its use of data and making it much more accessible. I think with more data being accessible, but not just more accessible, but in a timely fashion, coupled with the data analytics, coupled with the ability to sort of make informed decisions, or computers, not humans, making informed decisions around the data, then you can start to solve the problems that the business banking have with, it's trillions of dollars of funding gap that is out there that is not being served because there's an abandonment rate, they don't know who to go to, they don't know how to get access to funding, and the banks and the non-banks, particularly the legacy institutions, are phenomenally slow. And I used to work for one. 44 days to turn around a loan application is ridiculous. It should be, 4 hours, really. So that's where we need to get to. And on your point on CDR, GDPR, and the data and the ownership of the data, I have I don't dream about this, but I do believe that if you put the power of the data into the hands of the owner, the institution, and as Simon I think was saying, it's phenomenally complex when you look at businesses over individuals. You could ultimately get to a point where you put up that data and there's a bidding process for your business. Because you say, here's my data, here are my financials, these are my UBOs, this is my company, these are the contracts that I have, this is my sales ledger. What are you going to give me? That, for me, is where you put the power back into the demand side and you make it instant decisioning for what is required by the consumer, the customer, business customer. And that will keep the regulators happy because there's a suitability element to that as well. Right product, right place, right price, right time.
So that's not just about the data, that's understanding the data. So technology is not going to be just having the data, but also how do you analyze the data faster to give better results. So where we are seeing is understanding data is quite hard, right? If you have a tractor, how do you value that tractor as an asset, right, from farming point of view? So coming from that point of view, how much data and how data is going to be used is currently, we're all talking about the positives. When does it start becoming negative and banks starts deciding against you for using that data? So currently banks don't lend you mortgages if you have after-paying your account statements, or your insurance go void if you bought smokes or you bought to cash out on, in Crown Casino. When does that data become negative and the use of data become negative?
I've got one a one sentence answer to that. Ultimately, if you're taking risk out of the system by having data that demonstrates that actually there's something wrong with, or there's something inherently problematic with the information that you've got, then that should take everybody to a better sort of higher plane in terms of compliance, in terms of good banking and good business practices. That's my view.
Shilpa, what do you like?
There's another angle to this. Like, as a SME, if I was going to open a cafe and if I approached a bank for a loan, and if they were able to look at the data analytics that they have and tell me, businesses like you in that suburb have this kind of a footfall, this kind of a working capital requirement, and this kind of a revenue profile, that is gold as information to a SME starting out and seeking kind of, funding for that. So the application of data is basically the kind of, the power. And I agree with Alan, data is not bad, how it's utilized, how it's used, transparency. It only ever leads to better lending practices, if nothing else, right? So.
Yeah, I agree. And I think some of it too is as we cross into this world with more and more access to that kind of information, there's also an adjustment period to understanding what really matters in that. So like the buy now, pay later example, I think everyone's still understanding the implications of that and understanding, what that means for customers. So there may be a more conservative reaction up front before we understand how best to use that data and what it means for the individual as well.
Sorry, go on, Mel.
And there's another side to buy now, pay later, right? There's sell now, receive later, right? And that gives, the ability to finance that receivable is a very important element to the working capital requirements of a business. And I think we've been spending a lot of time talking about lending. It's not just about lending. I mean, if you're a financial institution and you're supporting the payments and you have the account activity of a customer, and you see that they're in Australia but they're getting a lot of US dollar invoices, you should be hitting them up with FX spot prices, FX forwards immediately. As soon as you see that data, offer them something that adds value to their business. And it's not just lending.
To increase stickiness, right? That increases that you understand your customer better.
Yeah.
So Alan, on that point, right? Trade Ledger is a global organization. So what do you see in global markets that is not available in Australia today, and where is the market going?
I suppose I've got two answers to that. It's not just about Australia learning from overseas and vice versa, but it's we've already talked about bringing what consumer banking has done and bringing it into the business banking world. That's the first thing. The second thing I would say, and I have been a banker in 11 countries, so seen a bit. There is too heavy a reliance here in Australia on term loans, fixed asset secured lending that is 5-7 years, and it's old style banking is the way I would put it. We should be looking at the transactional activity of the client of the business customer, and like Prosper does and others, and what we support at Trade Ledger is understanding that transactional flow within a business, the ledger, the AR, the AP within a business, and lending against that, offering services against that, because that is the underlying business that your customer has, not that you're lending them 7-year money against a factory. That's what I would say Australia needs to get further up the curve on.
Yeah, and I think we do see examples of that, and this is sort of a counterpoint to yours before, Simon, about how that fast access to data can unlock those sorts of new opportunities. Like we see players like Square and Shopify, because they have that access to the income that customers have. I mean, they have new products, new offerings now, where they can make decisions, proactively. They can make offers proactively to customers. But, one of their pieces is that they don't even have to rely on the individual credit history of the customer. They can rely solely on that information with a related sort of business model. So I think that does kind of introduce more competition, and maybe more data is still a good thing.
Simon, would you like to counter that point?
Well, a bit controversial, Simon.
We decided there'd been too much agreement at this conference before trying to drum.
I want to make it a little more entertaining.
Yeah.
But no. I think it's kind of the point where you're coming from is additional data sources, right? So that you can actually change the way that you lend, whether it be secured, and you could argue you had a supply side, it was laziness. If you can get a asset-backed lend, it's easy, right? But then as more competition comes in on the supply side, as you have more access to data, whether it be some of the names, the Shopify's, etc., of the world that you can leverage, Wayfire, etc., then you can actually have more creative lending, faster lending, because the problem is not the market size at all in the SME lending space.
Yeah, agreed.
So I think finally I would want to open it to the people here. If there's any question for the panel. I do have to. We answered a lot of questions. So I think my final question is, what kind of architectural trends are going to be helping fintechs to open and partner with banks and banking and non-banking lenders, as well as looking at the servicing side? How would you see that future going with the new platforms? Shubha, do you want to?
Yeah, sure. So as the architect on the So one thing, there's acknowledgement in the ecosystem that not everything can be done by one entity alone. And that's basically driving the trends around opening up those architectures to enable interchange between different entities. So you see microservices enabled architectures, you see container based deployments, open banking APIs to the extent that open the interchange between entities. We're all kind of considering these aspects very central to providing that end-to-end value chain. I know, even big old tech companies like Oracle, we're basically transforming and redesigning all of our application stack, keeping this new model in mind, whether it is opening up the cloud infrastructure for more, open banking and interchange and fintech collaboration, or it is, even redesigning our legacy application stack to fit into more container-based deployments and microservices-based architectures. That is a trend that's happening, and those are the architectural building blocks that are required to open up this ecosystem. For Oracle, I would just say data is in our DNA, and we are buzzword compliant. So you basically kind of talk of something, and we have it
Fill in
some
that
way,
blank.
shape, or form. Servicing side, I think Alan and Simon can talk more to that.
Servicing is complex because it's an in life sort of capability that you have to offer. The opportunities are endless in terms of early monitoring, being able to predict and understand and A, reduce your risk, and or B, hopefully even better, offer up something that the customer might need in terms of risk mitigation or a change in the lending structure, the change in the look of the balance sheet. So technology and the way that you architect the solutions with your technology can go a long way to improving that sort of that relationship, and then that of course creates enormous stickiness. And actually, we're working with a global institution in the UK and talking to one here in Australia about this very need to have that ongoing servicing capability on our platform.
I agree with those points. I'd also say if the question was how is it going to like truly change going forward, I think standardization, or if you can have outsource the undifferentiated heavy lifting, if you can take a technology solution, whatever piece is, in SME lending, there is 10 pieces before you get a loan, and you can outsource, I think, close to 7 of 10 of those. One of those is not your credit decisioning, but, as far as actually what you're doing. But I think there's different modules that you can outsource, and if you can find someone that has done that 100 times before and it is undifferentiated, whether that be the KYC ML part, whether that be the distribution part, if you can outsource that, you can move faster and you can usually do it cheaper, and you have a better chance of having a competitive advantage.
So thank you. I think we are right on time. Thanks a lot to the panel, and thanks for listening.
Thank you.
Thank you.
Great. I'll just give it a minute and then we'll get started on the next panel. It's quick. That's all right.
Number one, all of them.
I'll give it one more minute. Okay, so moving on from business banking, we are moving to home ownership and talking all about PropTech. Joining us on our next panel is Lara Paholski from thelawstore.com.au, Mark McDuffie from Downsizer, we've got Dean Fraser from Brickfloor, and moderating the panel is Paula Guino from Austrade. Thanks, guys.
I'd like to begin by acknowledging the traditional owners of the land on which we meet today, the peoples of the Kulin Nation. I also pay my respects to the elders past and present. It's very exciting to be here today talking PropTech at Intersekt. So I'd like to introduce Lara Paholski, CEO of thelawstore.com.au, a law tech which has developed a solution called LiveSign. LiveSign biometrically binds a person to their signature at the precise point of signing a digital document. Lara has been in tech since 2014 when she co-founded a national digital verification tech startup, which was later acquired by a large scale-up legal tech company. Then I have Mark McDuffie, co-founder and managing director of Downsizer, an innovative digital platform for homeowners with equity to purchase a new property off the plan with no cash deposit. His Downsizer is 2022 PropTech to watch at the Australian PropTech Association Awards. And Mark comes from a banking background with almost 30 years experience in international wealth management, institutional banking, and markets industry. And Dean Fraser, founder and CEO of Brickfloor, a PropTech empowering home ownership for Australians through a market price guarantee. Brickfloor was named the most innovative PropTech of the year in 2021 and 2022 at the Australia PropTech Association Awards. So I'll pass it over to you so you can talk a little bit about your solution. And I think the biggest question is PropTech or FinTech? Lara, would you like to talk about LiveSign?
Sure. Start off by saying that with LiveSign, what we do is we actually tell you who is behind the device at the precise point of signing any digital document. And we do that by biometrically binding the person behind the device to their government-issued ID at the exact time that they're signing a document so that you can know with certainty who's actually signing that and we're not compromising on security. And it's what really commonly we refer to as Know Your Signer.
Very good. And Downsizer?
Downsizer is a unique blend of digital technology and a financial instrument. So depending on which day of the week and which conference you're at, you're InsurTech, PropTech, FinTech. As far as we're concerned, we are a FinTech in a real estate sector. We allow homeowners with proven net equity in their current dwelling to buy their next property with zero cash deposit because they've got fully backed assets.
Very good. And Brickfloor?
Brickfloor is a property technology and funds management business. So we basically alleviate the stress around selling your home through a core product called a market price guarantee. Effectively, it's a market price on your home before you list for sale. We're also looking to broaden that concept through combining it with a home loan product. So it'll enable you to buy before you've sold with confidence. So we're creating a new sort of category of loan through our core product of a market price guarantee. And we end up buying homes by virtue of our market price guarantee. So we're building out a property fund or a portfolio of great Aussie homes that we're looking to now open up to young Australians as a home deposit saving mechanism where they can tap into the market and get on the property ladder in 9 minutes, not 9 years, through access to our property fund. So there's a few different moving parts to the business, but really about providing certainty to home sellers and helping people buy before they've sold, and also helping people save in a better format, we think, for their first home deposit.
So on the topic of PropTech or FinTech, what are your thoughts? Lara?
Very
Bit of both?
bit of both, and we probably cross over a lot of both in that we're servicing a lot of the property-based institutions and companies, as well as financial, but we're really operating at the intersect, I would say, of both.
Mark?
Yeah, as I said, we're kind of agnostic to the label, but we're a financial instrument. We started with a financial instrument that basically has to mitigate and transfer the risk that it underpins our product, and then we built the digital technology and distribution on top of it. So, as I said, we would say we're a insurtech or fintech in a property or real estate space. Our business model, if I know that Paola has a $3 million house currently, and is buying a $1 million apartment, but she wholly owns the $3 million apartment or house, she's clearly got enough equity to buy the future one. But we then, if we know exactly when Paola's property is completing, we know that her net equity is available. So then it turns into this adjacent opportunity of wealth management, financial services, insurance products. So there's a whole raft of opportunities after what we call that initial product is a lifestyle change. So our mission, for example, is to help an entire generation stop worrying and start living, because we see that initial property sale for people that are downsizing their home as a lifestyle gateway. So there's a bundle of products that could come after it that would be insurance, financial services from the PropTech.
Yeah, and assuming that applies to brick floor as well?
Yeah, exactly. Like I try not to get too caught up on PropTech or FinTech personally. I think there's a huge amount of overlap there. Like we're all trying to remove friction, provide sort of confidence and certainty in the market, and do things at speed. And that's certainly, I think, what we're all looking to do here. And it's just that we've got a sort of a property lens focus as opposed to maybe sort of a money focus, if you like. So there's a lot of overlaps there. But and we probably used to position ourselves a little bit more as a prop tech, but then and we still do, but as we've sort of expanded our product set, we can see, like Mark, like there's a lot of financial product style opportunities that come of our sort of core product, whether it's the property fund opening up to millennials, or whether it's combining with a home loan. Like we're sort of moving into that space, but we kind of felt like we're probably already in that space anyway, but we just were sort of labeling ourselves as PropTech. So yeah, pretty. I think they're reasonably synonymous. Probably 90% of the time, like if you're a PropTech, you probably are pretty much. You've got some overlaps with the financial system, and you are almost a fintech as well.
Yeah, absolutely, and all in the space of enabling the transaction. So I just have a question specific to you, Lara. I've been in the PropTech space for quite some time, and what amazes me the most is the fact that a lot of the technologies that are empowering real estate in many different aspects, be it transaction, or if it's planning, construction, design, all of that seems to happen outside the walls of the larger organizations, the real estate giants. And I wanted to understand from your side, Lara, as there is that convergence of PropTech, FinTech, and InsurTech in pretty much all the products that you're talking to us about here today. From a legal perspective, what is the impact from a legal tech perspective of LiveSign in actually removing the friction in real estate transactions?
I might start off, Paula, by just going back a little bit in terms of real estate transactions. And if we think of all of the legal documents that we need to sign throughout a transaction, and as we're doing that, typically in the paper-based world, which actually wasn't so long ago, people would be signing those documents in a real world with someone there witnessing who is actually signing them, and generally looking at the ID documents at the same time. So we actually knew who we were dealing with throughout the entirety of that transaction. and it came, of course, with a whole lot of friction. It wasn't terribly convenient. People going down to the post office or having to go into their real estate or lawyer's office to sign transactions, and it was really clunky. But it did absolutely come with that certainty. In the rush to digital, what's actually happened is, whilst we're transacting conveniently and it's online and we can do that pretty much 24/7, the witnessing component and the certainty that actually came with that has been lost along the way. So again, if we think of all and they're great technologies, the signing technologies that exist out there at the moment, they go from keyboard to keyboard. They don't actually extend beyond the keyboard. And that's where live sign comes in, and that's where we actually saw a gap in the market. And we wanted to bring to the market and the participants within the market certainty of them knowing who's actually signing those high-value legal documents at the precise point of signing them so that they could transact safely in the online world. And we do that, as I mentioned before, by biometrically binding the person behind the device at the precise point that they're signing those documents, by matching them against and their facial, or the biometrics of their face against their government-issued ID. So we're really removing a lot of, the friction that was there previously has actually been removed, and we're enabling people to now transact online in a safe and secure way, know who they're dealing with throughout that transaction. And I think, a lot of those basic legal principles actually got lost along the way, as I said, in the rush to digital. Everyone's been quite caught up in that, but hopefully we're bringing a lot of those basic legal principles back in and enabling people to transact safely and securely in the online world.
Thank you. And now a question to Dean. Property ownership is a very relatable topic and one we end up hearing about on a daily basis from personal conversations or in the news or just about market predictions. How does brick floor fit into the current economic environment?
Yeah, good question. So obviously the current economic environment involves rising interest rates and I guess uncertainty with asset prices all around the world, whether it's the share market or the property market. There's volatility and there's a lack of certainty really in terms of what your home is currently worth or what your shares are currently worth. And we've seen a lot of pressure on the share market, and we've started to see pressure on the real estate sector as well in terms of prices softening across most states in Australia. So with our core product, the market price guarantee, it's all about providing certainty to the home seller. So volatility, in a way, is our friend for our product because we provide absolute sales certainty for a home seller's sale process, i.e. a market offer before they've listed for sale, and they can then take the home to market, try to get a higher price. If they can't, we step in and we buy it. If they can get a higher price, they're free to sell to that third party. So in the current environment, we think is really sort of conducive to us really accelerating and growing our business. It does come with it some risk, obviously, if we're then buying homes into a property fund that we're looking to effectively institutionalise residential property as an asset class. You need to have investors for that property fund that are long-term patient investors who like resi and thinking sort of medium to long term as opposed to where's the market going to be in the next couple of years, which is obviously a short-term thinking approach. So the certainty aspect of our product is we feel really valuable in this type of market. Also, if you're looking to buy your next place, like what we discovered in being in market was that basically 90% of the population in Australia would prefer to buy the next home first before they've sold their current one, if it's safe to do so. But the problem with in the market at the moment is if you're buying first, you're really taking a lot of risk often because you don't know if your current home is going to sell within the right time frame and for the right price. And so we lock in that sale price for the current home, enabling that person to safely buy before they've sold. So in a softening market, people still prefer to buy first because they want to know where they're going before they've sold. It's a bit like, I think when you sell first, it's a bit like if you've got kids and you're taking them out of school to go to a new school before you've actually found that new school and signed up and spoken to the principal. It's a bit crazy to be selling first or taking your kids out of school before you know where they're going to. You should go and talk to the next principal and say, hey, I want to come across, my kid's fine to come across. agree that, and then look to take your kids out. So you should buy first, in my view, and do it safely, and then sell your next place. But the problem is when you do buy first, often it's not safe because you don't know what you're going to get for your current home. So anyway, in a weaker market, the desire to buy first is still there because people want to buy and sell in transact in the same market cycle, generally speaking. But there's a whole lot more risk around that sales side. So again, with one of the products we're looking to launch with a major lender, it will combine our sale guarantee, market price guarantee, with a home loan, so that you can actually safely buy first, meeting that 90% of the market sort of desire to buy first. And then I guess one other sort of related point is, in the current environment, like as you sort of all know, if you're filling up your car for petrol, or you're buying groceries, like the cost of living has just skyrocketed. I think I filled a basic car up the other day for $180, which is ridiculous. I couldn't believe it. So everything is costing us a whole lot more. So we're trying to build out of our property fund effectively an investment app that will tap into that fund to let millennials save faster for their first home deposit. And so that whole savings journey has become, I think, a whole lot more important. It's always been important, but particularly when you really are struggling to save, even as an adult, it's hard to save your pennies when you've got a young family, for example. So anything that you can do to help people save and get into their final dream asset purchase, whether it's a car or a home or travel or whatever they want to do with it, we think that's really important in the current environment to really sort of help people save and get into their next place.
Absolutely. And I've known Mark for a couple of years now, and I've been always, fascinated by the idea of downsizer. And I've recently watched an interview where you, Mark, mentioned that Australia has $1.7 trillion of long-held residential stock that could be released into the market in the next 5 years. What is the role that downsizer plays in enabling these transactions?
Thank you. We have fantastic data that basically outlines as you're saying, a large shift in the age 60 and above looking to release long-held residential property stock. There is actually a tax incentive for downsizing their primary dwelling. They can put $300,000 of additional super into their super fund from a downsized transaction. That's $600,000 per couple. The government has reduced that to age 60. So that's increased our market for asset-rich, cash-poor homeowners looking to buy their next property and simplify their lives. Basically, how our product works is that we qualify the net equity position of the buyer, and we connect them on the other side of the marketplace with property developers looking to sell. And we've talked a little bit about the macroeconomic trends here at the moment. We see our asset-rich, cash-poor homeowners and we're educating them on the fact that they have buying power. Because for every mortgage that's approved to buy off the plan, the banks get the right to revalidate mortgage affordability 90 days from settlement. If the interest rates and inflation continue to rise, our prediction is that the affordability of mortgages will be 20 to 25% impacted, meaning there's less qualified buyers in the market. Our buyers can come onto our platform, and depending on what state they're in, state being the state of domicile. So if they're in New South Wales, for example, and they wholly own their asset, we can allow them to buy off the plan within an hour. Right? So if they have all their information real time, there's no mortgage approval, because guess what? They wholly own the property they own, and it needs to be at least equal to more than the price they want to buy. So if I've got a $2 million house that I wholly own and I want to buy a $1 million unit, why should I have to find a $100,000 deposit to put in a low interest escrow account? Just to hammer that home, I'll tell you about one of our last sales, which is really humbling for us as a new startup. 79-year-old guy, lived in his house for 30 years. The utility bills are the highest he can ever remember because cost of living is going up. He has almost no source of income because his superannuation is low. His house he can't take care of and maintain. His garden, his shoulder height, in his words. And he has a line of credit from a bank that he's had for more than 15 years that's at its limit. That's accruing interest on a daily basis that he cannot afford. But he's landlocked. He can't. So he walked into one of our partner clients and he bought off the plan for a $600,000 apartment near a new hospital, near new amenities. He doesn't have to put the deposit down because we qualify that he has a house worth $1 million. So why should someone like that have to try and find a deposit and put it in a low interest account when they're actually fully asset backed? So we basically digitize that whole process with 14 APIs and make it real time if all of your qualification points are there. So we're streamlining that process end to end.
And most importantly, you're enabling for their property to go back into the market for.
Yeah, that's completely true. So we help them sell their current asset to align with the purchase or settlement of the off the plan. That releases that equity. So for every downsizer, there's an upsizer waiting to get onto that market. So if we release more stock, and government initiative yesterday announced or confirmed that there was 8,000 people downsized and took advantage of the government's tax incentive. That's 8,000 long-held properties that have been released that make it more accessible to those, all the way cascading through to first-time homeowners. So the more we release and recycle, the more the market should be stabilized.
That's amazing. Just about the size of the market, we just talked briefly, what that looks like for downsizer in Australia, for example. But I have a Deloitte report here that says that with nearly 9 trillion in global assets, commercial real estate as something else is larger than any other class of financial services assets. However, what we see is so not just considering residential real estate, but also in commercial real estate, we find that in real estate, adoption is an issue. How do you see your business overcoming that in the residential space?
So we're working in the biggest barrier for us is actually the incumbent construction lending banks adopting this new bond instrument and technology because they've just never seen it before. But we are demonstrating that there is market pull. We are only advertising in 18 suburbs, but we have demand now in 700 suburbs across Australia saying that I'm a downsizer and I live here and I want to live there. So to me, consumer pressure, in our opinion, will drive that through and change the construction lending conversation that we have. But it's more about adoption and just understanding and education.
Yeah, and for you, Lara, for LifeSign, is there an adoption hurdle that you need to overcome?
Very much so for us, Paula. And I would say that's part of the journey that we're on, which is actually for us very much an educational journey at the moment, in that most people that we're dealing with or companies seem very comfortable to be or sending out to their clients documents to be executed in the online world without actually knowing precisely and resolutely who actually signed that document. So for us, there's an education piece to, help the market or the participants in the market actually understand the inherent risks that come with that, and not knowing. Whilst it all existed and worked really well in the paper world, there's inherent risk with not knowing who that is in the digital world, and that's where we can help. And for us, it's about shifting that mindset to get people to think beyond the keyboard of who's actually signing those documents.
Yeah, and it seems that disruptive technologies always have a role to play in the fact that you need to educate people into adoption. And I'm assuming that is the same for you, Dean?
Yeah, definitely. Like, we had some interesting experiences when we were trying to find out sort of, channel market fit. Like, I think people talk about product market fit a lot, but I kind of see it like there's you've got to have the right product, of course, but you've got to have the right channel for that product. You've got to have the right positioning and marketing for that channel, for that product. And so you need a bit of luck market fit and a bit of timing market fit. You need all this fit to kind of happen at the same time. So it's not just having the right, because you might have the perfect product, but if it's not positioned the right way, the right channel at the right time, the right place, et cetera, it doesn't quite gel. So, but we found, for example, with real estate agents, when we first went out to market, we were pushing out through real estate agents saying to them, look, we can guarantee for our market price guarantee product, we can guarantee a sale for your home seller customer. So if you've got a customer sitting on the fence as to whether they want to sell or not, you can actually get them over the line through saying, hey, there's no downside risk here. You're going to get this minimum price, floor price or more. But the adoption was tricky because those particular agents that we're dealing with, and I think probably it's a generalization, but it's reasonably typical, they want to promote themselves when they're trying to win a listing, and they want to say how they've got the most market share in the market, and that all you really need is me as the agent to help you sell that home. So to introduce a side product that is important and can help them win a listing was initially difficult, particularly for the younger agent who he or she wasn't, I guess, as equipped to say how a product like Brick Floor could fit into the sale journey, whereas the more senior agent was able to say, look, we're the best agents in the market, and we have all the market share. But as a professional, we like to have a plan B scenario, and the plan B is Brick Floor, guaranteed sale outcome. We can leverage that price to get a higher price in the market is the game plan. But it was certainly sort of hard because in the end, the adoption was a bit tricky through the agents, because even though we had big engagement from the chairmen and women from big agencies in Melbourne in particular, when it came down to the junior agent or the listing agent or sales agent who might be in their 20s, for them to kind of explain how the product was fitting into the sales journey was a bit harder, and they're a little bit, with respect, a little bit sort of blinkered in how they would pitch their own skill set to the market. So we had to sort of think about, other ways and other channels, mortgage brokers and the like, and going direct to the customer as well to try to get that adoption. And still even going direct to customers, we found, you get the early adopters who are, creative in their thinking and open to trying new things, and then would get, other customers that would never going to become a customer until maybe in a few years' time, but who were sort of more fixed mindset, but were sort of intrigued about what we did. But to adopt, to get the right customer and find that right customer, that was an initial challenge, because they were the ones that were more likely, the more innovative customers were more likely to take out our product. So certainly, I think with any new business, fintech, PropTech, any type of tech, there is a big sort of adoption, trust and credibility issue. We also confronted that too. There a lot of questions like, how do you guarantee a price? Like, that's not possible. Well, we end up buying the home. Oh, okay, so you offer a sort of lowball price for our home. No, we offer a market price. It's a fair reserve price. But there was a lot of distrust, so we had to sort of try to deal with that as well. And I think a lot of things like what we're doing now, and applying for awards, we'd never done that before until a couple of years ago, and then we were lucky enough to win a few, and that for us gave us a lot of credibility too, because we put up the little logos on the website and also on our email sign offs, and people would go, oh, okay, well maybe they are kind of legit with what they do. And so, but certainly we're still going through the the adoption curve and working out ways to improve it. But I think for us it's like finding relevant partners, in whether that they're a lender or a mortgage broker or a real estate agent or portal, who have that credibility already, and for us then to sort of partner with them while at the same time we sort of go direct to the customer. But having a trusted partner really helps, I think, accelerate that adoption.
Yeah, absolutely. I have one more question, but we're running out of time. Just wondering if there's anyone that has a question. Oh, yes, we've got one question. Yep.
This one's for Mark. First of all, love the product. I'm definitely going to introduce it to my parents. They need it.
Yeah, send them my way.
I was just wondering, this is a question around mitigating risk. So I tried to buy off the plan a couple of months ago. As a first home buyer, I lost half of my deposit, which was really sad for me. It was just because the developers, they claimed bankruptcy. It was this whole thing. I was just wondering, how do you guys deal with that? How would you guys deal with that on your end?
First of all, I'm really sorry to hear that experience, and this may not be the right time to say it, but our product actually prevents that, right? Because it's a cashless deposit, all right? So for a downsizer segment that are probably making the last big buying decision of their life, trust of developers is a big thing. So 2 ways we mitigate that. Number one, if you're in New South Wales, there's a ICE certification, which the developers have ratings that they have to adhere to. So we only onboard if developers are legit and they are, their cash flow is high quality product, cash flow is proven, all that kind of stuff. So we would mitigate that risk. Anybody that's on any property that's listed on our platform has been vetted, number one. Number two, if you were putting a cash deposit and a developer went bankrupt, it's really unfortunate, and I'd love to talk to you afterwards about to see if we can help in any way through our network. We might not be able to help ourselves, but I'm pretty sure we can have a talk about it. But if a downsizer puts let's say put $100,000 deposit down, that's almost definitely their life savings, right? If in your case that they put that down and the developer went bust, they would almost definitely lose that money. In our case, there's no deposit because we prove that the downsizer has the money and they will complete because we help them sell their existing dwelling nearer the time of the completion of the off the plan. So we de-risk the purchase of the off the plan, but we do actually have a financial instrument that underwrites and protects the developer as well. So in our case, cashless deposit, that deposit, the cash deposit doesn't disappear. So I'm happy to have a chat with you afterwards if you just grab me.
That'd be great.
Well, thank you very much. That's all we have time for. So thank you so much. Thanks to the panel.
Thank you.
Thank you.
Thank you, guys. That was great. I'll give it 30 more seconds and then we'll get started. Alrighty, so our next session is all about the emergence of supertech, and I had the pleasure of meeting some of our next panel members last night. We got into a really, really nerdy and slightly tipsy conversation about the opportunities in super. So without further ado, I'd like to introduce our panel. We have Trina Probert, the founder of Superfierce. We have Christina Hobbs from Verve Super. We have Stephen Riley from Hester, and moderating the panel, we have the very fashionable Brian Collins. Thanks, guys.
Hi, everybody. Thank you so much. So my name is Brian Collins, former board member of FinTech Australia. Always love coming to Intersekt. Some of you may know I've recently started a new job. I am now the FinTech BDM at AWS. However, this panel was set up well before that. So just to get some admin out of the way, everything I'm about to say is my own personal opinion. Legal if you're watching. There you go. If you have heard me talk, if I have talked to you, if you have listened to the FinTech Australia podcast at all over the past few months, you've heard me talk about supertech or superannuation. In my mind, this is one of the biggest open goal opportunities that is available in finance and in FinTech, and especially in Australia. It is a unique opportunity in the Australian FinTech landscape. It is an industry that is currently worth about $3.4 trillion in assets under management. That is rapidly increasing the $4.4 trillion held by the major banks in the country. While most of us think about super, we think about the product of super, but the real opportunity is the fact that super is more than one product. It's not just our superannuation. It's super, it's retirement, it's legacy planning and passing that on to others. It's also the additional services that are provided, such as insurance. It's paying out to different people. It's every fintech in this room. And there are businesses like Mercer and Iris and Link who have made billions of dollars servicing this industry, but those are now legacy systems. And it gives us a really powerful opportunity. So I wanted to pull this panel together to talk about that opportunity. And I'm very pleased to have this particular panel today. We have a fantastic startup, a fantastic scale up, and a fantastic industry fund here. And I'm gonna have them quickly introduce themselves, starting with my left, and Christina.
Great, thanks. It's awesome to be here. I'm Christina Hobbs. I'm one of the co-founders and CEO of Verve Super. And Verve Super started in early 2019 as a superannuation fund tailored for women. We had three core, differentiating factors to us. But really the core one was that we saw this powerful opportunity to partner with our members for life on their retirement building journeys and to really be a financial partner for life. So our real focus was how do we package a whole lot of great general advice and community using superannuation really as a business model to provide that. So today, although we feel much larger for us, we're still a tiny little drop in the ocean compared to some of the much larger players like Hester. But I think that's really interesting for today's conversation because you'll be able to see the challenges and the opportunities at both ends of the spectrum there.
Before we go to Stephen, the question I forgot to ask that I want to hear from each of you as well. The biggest opportunity that you currently see in the super space?
Well, I'll sort of be a little bit controversial potentially because I don't think it's an area where the regulator particularly wants us to go. But I think looking at general advice and how we can provide tech around general advice is going to be a really interesting focus area.
I love it. Stephen.
Hi, thanks for having me. I love what Verve Super's doing. The startup super space is really, really interesting. So I'm from Hester. We are, I suppose, one of the large super funds you're talking about. We've got about $68 billion under management. It's pretty big. Well, we only just sort of, depending how you cut it, we're somewhere between 10th and 12th in terms of size. We have 950,000 members. The majority of them are in health and community services. So we were set up for nurses, midwives, aged care workers, early childhood educators, and community service workers. So it's a very easy organisation to get up in the morning and work for. You know, if you meet any of our members on the weekend, it is usually you at your most vulnerable. So it's a wonderful cause for that respect. When we're thinking about this space, about 5 or 6 years ago, it's interesting actually being 10th that we need to figure out how to stay competitive with the so-called mega funds. They're 3 to 4 times our size. At the moment, we're more efficient than they are in admin space. They're more efficient in the investment space. And we need to make sure they don't get away from us. So about 5 or 6 years ago, we invested in data integration, APIs. We said that our future is as an ecosystem. And that includes, big time, tapping into new thinking, new tech, and figuring out what's the best of breed sort of ecosystem. Answer your question about the biggest opportunity. Look, I think you sort of flagged it a little bit. It's the decumulation side of superannuation, in my view. Accumulation there's certainly opportunities, especially in the operating model ecosystem. You're seeing a little bit of that. We've had Ignition Wealth work with us. We're working with Grow at Mercy Super. Some interesting opportunities in the operating model space in accumulation, but in decumulation, you've got a much more transactional relationship with the member, and they need to do more stuff. And frankly, we're not set up for that, so we need to partner with people who are thinking deeply about it.
So we've got general advice, we've got decumulation. I can't even say that word. But we're going to go...
Retirement.
Decumulation. No, not going to happen. We're going to go to Trenna Probert next. Trenna, who are you? What is Super Fierce? And what do you see as the biggest opportunity in the space?
Hi, everybody. I actually tried to get Brian to serve drinks in here this afternoon because I was pretty sure we wouldn't get anybody here. So thanks for coming to talk about super with us. And I also want to clear up the fact that I was not the tipsy nerd talking about super last night at dinner. Pretty sure somebody else on the panel was that one. So I'm Trenna Probert and I am the founder and CEO of Superfierce. We have built a scalable advice platform which is designed to help close the $30 trillion global gender wealth gap, starting with the 47% gender retirement gap here in Australia. It's important to call out that whilst we focus on women first, we are indeed for everyone. So feel free to come on our platform and check it out. It's not a very well kept secret that about 80% of financial decisions in households are made by women. And that's why we have 25% of our customers are men, I suspect. So we don't even have to market to you and you still come on over. But we are focused on trying to bring transparency to what has been a very complex and largely opaque industry. And we do that because we know how important superannuation is as a financial asset, not just for individuals and consumers, but also for us as a nation, and something that I'm sure we're all very proud of. Strangely to me, I never expected to find myself working in super, to be clear. But is that, we are well regarded all around the world for having one of the most advanced and sophisticated systems in the world. So that's why it's pretty awesome that we're sitting here working out how we can do it even better. And that's really what we're all here to do. And I think Brian's done a great job in crafting the panel, as you say, from a little startup, nibbling away at the edges of things. Christina and her team have been doing a great job of scaling up. And then, of course, Hester, despite only being 10th on the list, is pretty big. So in terms of the opportunity, I think they're vast. And it's why I'm excited that we're having this conversation, because the use of technology is not just around efficiencies at the edges, although we all agree that we could do with some better systems behind the scenes in the superannuation industry to make it more effective and more efficient. What I'm excited about is that I actually completely agree with the decumulation, and we've got a real focus on building out support for people in that retirement income pillar. So we should definitely chat about that later. But where I see the real opportunity leveraging technology is to actually engage people earlier in life and through life so that they can understand the impact that this can have on their own lives, but then also within communities. And, everybody benefits, right? When everybody's doing better, we're all taxpayers. So even if you're a cynical bastard, we should all be motivated to improve this, because ultimately we all benefit.
So we've talked about a couple of different opportunities there. There's one opportunity we all agreed ahead of time that we wanted to talk about and kind of share. So there's been a lot of talk around CDR around the entire conference. And we've talked about CDR, and if you've looked at the timeline online, you can see that it's telcos currently, it's energy next. And then there's a variety of other spaces that it could go. It is becoming more and more clear that superannuation is either going to be next or soon to be next. CDR offers a very interesting opportunity, and just one of those opportunities is, and many people may not know this, but many super funds don't actually know who their members are. They're paid by their employers, and they know who the employer is, but they don't actually know who the individual member is. And having CDR actually implemented into a system like superannuation as a whole industry can very quickly parse and fix that. I'd love to hear from each of you. What is one of the areas around, where do you think CDR plays potentially the biggest disruption area? Or, so you have a choice here, or where do you think that it's going to need the most help to be successful in the industry? And I'm going to completely open it up. I'm not going to call on anybody. I love an awkward silence.
I can go first. I think for me, I can sort of really immediately see some of the potential opportunities if you take the lens of a superannuation fund really being a retirement partner for life for your members. So I think some of the very immediate things is being able to see what's going on within our members' financial lives that could indicate changes or suggestions that could make their life better from a superannuation perspective. So you can see things like, for instance, when they've been stopped being paid super, or if they've got changes of employment status, all those kind of changes that are happening that could then trigger events for us to actually be able to engage with our members to make certain that they're thinking about the right things in terms of their superannuation. There's a number of areas, again, like as they're approaching retirement, being able to interact and engage and make certain that they're looking at the right products. I think, as I was alluded to earlier, the interaction of superannuation with other products. So particularly on the insurance side, there's a real role here that when we have more transparency around what's happening in people's financial lives, that we can also potentially support them if factors are changing that could mean that their circumstances are changing, that could interact with ensuring they've got appropriate insurances. So I think that there's some really good quick wins that could happen in terms of being able to have a more open and accessible system to see what's going on. And then I think there's just a huge explosion of opportunity in terms of how we could use this to really better engage members and ensure that we're really partnering with them throughout their life cycle. So I definitely think for superannuation there's big opportunity.
I just know Brian didn't want to go one. All right, I'll have a go. I think, that's spot on. There's a lot of that sort of live data that would be incredibly useful. I'm probably a little cynical on some of the views, only because I remember looking at Mint in 2007, and that was the the first real breakthrough aggregator in the finance space worldwide, and they were going to take over the world. I was at CBA at the time, and I think it's fair to say some of the strategic folk there were scared to death. Turned out it was really quite hard to do, right? And the main reason it was hard to do was actually the engagement of the customers, because they had to plug it all in. They had to find the provider and put it together. CDR makes that 1,000 times easier. So once again, I'll come back in with an optimist's hat on and say, surely now it can work. But I still think it's got a little bit of clearing. Just some people will go down the easiest path, right? The most frictionless path, and I think CDR's got a little bit to go. I love actually that they're going a little more broadly than just the dollars, because I think people will find use for it in their daily lives, and then banking and super can come in and join that. Super is interesting. The way that they talked a lot about open banking was how people could switch. Super, you say you're switching, 3 days later it's gone, right? It's the most
Not always.
Well, yeah. So maybe not.
3 days and it's gone.
It may be gone in 3 days, but often doesn't turn up where it should be for months. But that's a different conversation.
I have no experience of that, so that's fine.
You're right, you don't.
But I was going to say in decumulation space, I'm liking CDR, because again you're getting into the way people spend their money. You have a reason to have an aggregated view and a predictive, early warning system about whether you've got enough to pay the energy bill, right? And I think that gets really quite exciting.
I probably have a reasonably unsophisticated perspective on this, and it concerns me that everybody's nodding, but probably a reasonably unsophisticated perspective on this, which is that, so with data just as a foundation premise, so long as we're using it for good, not evil, that's an important starting point. And I've already shared that my view is that things will work much better within most aspects of financial services, including superannuation, where we have greater transparency, right? And so that's really, for me, what this is about. We're all here to help. You're here to help your members, and I'm here to help consumers and to, stand up to my best interests, duty, obligations, and so on, right? So we can do that better if we understand our customers, but they need to trust us. They need to trust that we're going to use it for good, not evil. And I think that, I actually think there's just a massive opportunity for the industry more broadly to collaborate closely to make positive change.
So we've talked a bit about kind of general pieces. I want to dive deep into a couple of the products that we haven't talked on. We've talked a lot about super, which again is where most people think of. We pay into your super, money's paid for you into your super, and then you probably don't think about it that much. But the truth is that there's a bunch of other products out there, especially, and the one I want to focus on first is retirement. Retirement is a product that exists in almost every super fund. I believe, I could be wrong, but I believe both of the funds that are up here have retirement products in their suite. But oftentimes members aren't even aware that retirement product exists inside of the same company, or moving them over can be difficult. There's a variety of challenges. So Stephen and Christina, I want to hear from you guys around what are some of the areas that you see for opportunity on the retirement side of the product specifically?
I might actually throw that one over, because we actually don't have a retirement product, and we've actually been suggesting to some of our members to go to Hester when they're retiring out. So we haven't got too many, because most of our members are around the age of 30. But yeah, I'll hand that one over.
Thank you.
I think there's been about 4, so I'm sure it's
This
not.
is business being done on the panel, folks.
It's not a huge amount, but.
Oh no, I think. Sorry. So what's really interesting about engaging in super is that you'll find in about 15 years, all of a sudden your engagement peaks, because people start thinking about it at around 45. Honestly, the stats, the research on this is remarkable. I think, perhaps ironically, since the Royal Commission, engagement has been on a upward curve. We have more engagement about everything from underwritten insurance to people logging in just to check their balance. And I think so that's on the up, but by no means is that, I think, commensurate with how important your retirement savings are. However, from about the age of 45, people find their way to their super and start to look for help. And I think, to go back to Christina's first point about advice, that's when they start to get scared to death, right? And what's the right number? What do I need to do? How do I make sure I'm not the only idiot that does the wrong thing? And that gets really, really tricky. So I think the opportunity about engaging is actually to give members confidence. And I think that starts from the day they join, as young as possible, making sure that you talk to them in a way that they understand. Our website, the most complaints I get about our secure website is from my bloody investment team, right? Because they want it to be more sophisticated, more complex, and we're dealing with nurses, midwives, aged care workers who are incredibly clever professionals, but they don't think about this stuff. So how you can translate it to something, and to your point, they are doing the finances, they are planning ahead. If we can help them do
and they're better at it than they realize
they really are. So getting that confidence and engaging with them in their language, that's how you prep them.
I think the education piece comes across a lot of what we're talking about. There was another reason that I really want to make sure this panel was the panel that we had for this, because as already been mentioned, Trena and Super Fierce, very clear focus on women and enabling women through a variety of different ways. Hesta has a majority women membership group. Of course, Verve has been marketed as a female super fund. You were sharing with me a little bit earlier some of the specific kind of users and members that you guys have, and they're not always who you initially thought. You have a lot of people who've come over. I shared the story of my partner who has come onto Verve as a migrant who came over and came to Verve first. Do you want to talk a little bit about, you guys have a younger member base than most other funds. What are some of the things that you're seeing with your members, and what do they care about?
Yeah, so I think something that's important from us is we really took the perspective of how do we really support people in their financial journeys throughout their lives, and then let's use superannuation as a product or a business model to support this. And so that's been really interesting for us, and to see, I guess, who's resonating with that message. And for us, it's been a lot of people around the age of 30, and we see two peak engagement times in superannuation. One is around the age of 30, when people are suddenly like, I need to consolidate my accounts, I'm having a baby, I'm starting a new job, something's these life events. And then it's as they get older and they're thinking through to retirement. It's that first group that we're really attracting, and we're attracting them in a way that's they're just thinking about their finances. And it's been really hard for people to go. I guess what we identified was when people want to make actions on their finances, and there's a whole lot of general advice available in written format, but particularly we know with women, but a lot of other people as well in the market, is that they want somebody or a face to that. They know, but they actually want someone to tell them that what they know is right before they take action. So a big part of what we were trying to do is create this general advice environment where we can support people to take actions in a whole lot of way around their finances. And so, what we've realized is that the people that are attracted to that is really quite diverse, but very specific. It's people who know they're not on track with their finances. It's people that are young and starting out and having these moments, and they're waking up. And then it's also a lot of migrants who have come to the country and they don't actually know what superannuation is, and so they're engaging with us in that way.
And this is where I think that user group is super important, because that particular group that you've just talked about there, this is going to be for a long time their largest asset class when we think about it. So being able to protect that and manage that is really important. So Trena, that takes me over to you. With Super Fierce, you guys have started with a super comparison tool, but you have a much larger vision for how you want to be supporting almost not specifically this group, but especially women. There are men who use it. I'm one of them. But can you talk a little bit about...
Can you tell them how much money we saved you? Okay, maybe not today. Sorry, go on. What was the question?
$500,000. So what... can you tell us a little bit more about, so you're starting with this one product, but you have this large vision for where you want to be able to support these folks through their entire journey with this as an asset class. Do you want to speak a little bit about that?
Yeah, absolutely. And I just want to touch on what both Christina and Stephen said as well, which is, and I mean, we're a startup, so we're still learning as well. And we're often surprised as well, Christina, who we see engaging in different ways and more deeply. And yeah, it's a pretty exciting journey learning about the market in that way. But between the ages of 30 and 40, that's where the biggest life events typically happen as an average for women in particular. So, and women, guys, you're awesome, but you kind of have a slightly more homogenous earning trajectory in your life, and women chart a much more different course. So those years are very important, what they do. So I'm thrilled that women are engaging with you at that time, Christina, because obviously the magic of compounding is a really beautiful thing. The earlier you start, the better. But also from 45 is really fascinating too. And I have to do a plug. It's nearly my birthday. I'll be 50. You're all invited. And so I was recently invited to speak at a conference for women 50 and older. And it was fascinating to me. And I thought nobody would be interested in me because, they were talking about cool stuff there, makeup, fashion, menopause. No, that wasn't the cool part. But, I was surprised how engaged people were and the people who were coming up to me afterwards to ask questions about what they could be doing. And I've actually got some pretty horrifying stories, but we don't have time to do that. But going back to the retirement income piece and the strategies for those later years is absolutely critical. So at the moment, we are building out. We were tempted to go wider, but decided that we wouldn't go and fight in the bloodied waters with everybody else in financial education for a while. And so we've decided to go just much deeper into the super space. And because we're pretty good at technology, so what we're now doing is we're enabling our customers to be able to dynamically model the impact of different types of contributions, to be able to do that in the context of building a fierce life plan or a plan for their life, really being able to map that and bring relevance to why you care about your super. Being able to model the impact of time out of the workforce, critical for women in particular, but for everybody now with an aging workforce, with sabbaticals, career changes, all of these things. Being able to see that, giving people the opportunity to learn about investing inside their investment portfolio. And we think general advice is great. We would have loved to have stayed there longer because it's much less complicated. But ultimately, we made the decision to take that step to build a full scalable advice platform, because whilst education is terrific and tools are wonderful, there are times where people need more. And that's advice. So, we're deepening in there. We've got some other pretty cool things going on, but I don't want to give anything away too quickly right here. But ultimately, we will step into the other pillars of wealth as well. And particularly for women, we know that taking a very different approach than has been done in traditional financial services is very important, because our earning trajectory is so fundamentally different. And we are indeed independent and unique, just like all of you. But that's why we need something that really reflects the different life paths of women.
I think, for all of you here who are, have a fintech idea trying to find its way into super, that's a pretty good model, right?
Thank you.
You're welcome. It's a very lovely club up here. No, but I mean, so for Heston, 80% of our members are female. They're out of the workforce on average 6 years of their career. They come back in a contract and a casual capacity. It affects the way that we engage with them. It affects the design of our insurance for them. All of that sort of stuff, and having an opportunity to engage outside of the service providers, that separation is incredibly useful. But I think what's really interesting in fintech world, the fintech world we live in now, is actually how you can increasingly connect in either through CDR or just engagement. It's actually, super is a really interesting collaborative space because it's all about the best interest of the member. I truly believe that. I truly believe most of the industry feels that way.
I agree.
And they're looking for people to find the right help for what they need.
Look, and we've had a really vibrant, positive example of that recently when we released the Fierce Performance Index into market. And in all honesty, we were really frightened of you guys for a long time. We're like, don't notice what we're doing over here, because, we're a startup, and there's a lot of power in the superannuation industry. I know you're going to wrap me up, but I'm just going to keep going for a minute, sorry. But But what's really cool that came out of that was, we had lots of super funds reaching out to us and saying, hey, that's really awesome. You've worked out how to explain something that we've been trying to explain to our members for years. Can you help us? And then we've had others who didn't make it onto the Fierce Performers Index reaching out and saying, hey, you clearly know a bit about this. Can you help us to work out what we need to do under the bonnet to do better? And I love that. I think that's really cool. And I'm only going to throw one little thing in here, which is around engagement, because it's really hard to get people to pay attention to their super. That's what Verve has done incredibly well. And so, I really want you all to go to growgold.com.au, go and check out our really cool gangster granny rap video and play a game called Blingo, which we've created. Now, it's still a little bit buggy, so be kind to us, but it's an example of taking a different approach to engagement. So what we've done is we've worked out that we kept saying to people, okay, cool, you're on track to retire with this much. And they're going, yeah, but is it enough? And we're like, good question. So now this game actually lets people play a game to work out what sort of life do they want to have. And then we show them how much it's going to cost to have it. And then we show them if they're on track to be able to do that and then how they can close that gap.
So sadly, we're going to have to...
plug.
Sadly, we're going to have to wrap on that. But just to quickly kind of wrap up where we're at, the whole goal of this session, what I was hoping we get and what I think we've gotten out of is, as I said at the beginning, I just want to reiterate, superannuation is a huge open goal opportunity for the fintech space. It touches every single part of what's been talked about at this conference. And if nothing else, I hope that we've slightly opened your mind on the possibilities there. And with that, I'd like to thank my fantastic panel. Please give it up for Trina, Stephen, and Christina.
And Brian.
Thanks.
Thank you.
And for Brian.
Thanks, everyone. Feel free to head out for some afternoon tea, and we'll be back at 3:30.